Sales were good. Consumers are buying stuff. Yes, the upper end of the K, they are buying stuff, and the lower end of the K is buying gas, right? That's more expensive, or goods that might be more expensive, and savings rates are dipping. Hey, it's KP coming to you live from Corona, California. It is the first Monday of the month. We had our senior management meeting today, and it was a long one. And there's a lot that we talked about today, and I'll get into some of that and share some of the insights with you. But also hit you with the dose of reality on the macro and sprinkle in some positivity. So if you don't want to hear me sugarcoating anything or being positive or pulling the good nuggets out of the data we've been seeing, which we could get some more maybe for Jobs Week, then this is not the show for you if you don't like positivity. So I apologize for being positive. Rates are high, and I know a lot of us anchor our mindset to that, and it is kind of a tougher second half of the year. What's interesting is this was a pretty good July. One of the better Julys that the industry has seen since 2021. There's been a lot of delayed spring purchase business that pulled its way into it. We had a nice little reprieve in rates there, and some of those locks ended up funding last month. And so the second half of the year, which is usually a slowdown, is now 1/6 over with a decent month. Locks are decent here, up from May again, about the same level as June. So we're looking about the same amount of business here under our walls in the month of August. So now you'll have 2 good months for the second half of the year without any kind of refi help. And, you've got 2/3 left of the second half of the year. 4 months left. So take that. It's Jobs Week. It's very important. The Fed's dual mandate, even though it's really a tri-mandate, they have it's obviously, price stability, inflation, maximum full employment, which we'll get that data this week. Friday's data is the tier 1 data point, and last week's PCE was the tier 1 for inflation. It really is a tri-mandate, long-term stable prices like 30-year long bonds, 20-year bonds. And those are tested right now. The Bondanistas are out. And I'll get to the Fed at the end of this, but I'm going to go through some other stuff first. Unemployment rate is expected to be around 4.2%. And no one in the media has been jumping on stagflation yet. I'm surprised. So for the people that want to write about the bad stuff, who've been saying stagflation, which we haven't had stagflation, but you've been saying it for like 2 or 3 years, maybe now's the week to start saying it because inflation is sticky. And we'll see. Maybe the jobs report gives those negative writers more inflation. GDP did come in at 1.5%, but there was, this big drop by about 1% for, imports. Now, final sales number that was an internal data point inside the GDP number was 3.9%. Sales were good. Consumers are buying stuff. Yes, the upper end of the K, they are buying stuff, and the lower end of the K is buying gas, right? That's more expensive, or goods that might be more expensive, and savings rates are dipping. And I said this on our Crispin commentary podcast last week, and I don't want to sound heartless. I'm putting on my secondary hat. The secondary market is cold, heartless, and unforgiving. Some of the people who are struggling are not our customer. I'm not saying don't have a heart for them and don't worry about them. Starter homes aren't being built. Chase just put out $750 billion they're going to spend to help, 200,000 people get into affordable housing. They want to increase their mortgage business by 40%. I love it. I don't know without some more building, which of course the ROAD Act can help, especially with manufactured housing. But there's not enough starter home prices. And Kurt Loomis, I'm on his newsletter. He actually highlighted that last week, which of course we've all been talking about that for years. But $750 billion pledged by the biggest bank in the land is a great thing. Don't have the scarcity mindset. There's plenty of business to go around. It's a good thing that they're trying to jump in and put more money towards that. You want some good news? So the second quarter first lien residential loan data came out. $570 billion was done. That's up 8.6% from the first quarter when we had all that refi business at the beginning of the year. So we're just about 1.1 trillion in first lien business. Doesn't count second lien business and HELOCs and stuff like that. Government insured business drove much of the gain. 61.9% of government business volume in the second quarter was for home purchases, up from 54.2. That's a good thing. There's business out there. It's out there. There's so much out there. We have to find ways to go get it. Okay, let's get into some of the negative stuff. I saw, this isn't negative, but I saw the good folks at MBS Highway. They had a video talking about trim mean, and trim mean is kind of an average way to look at inflation. Chair Warsh talked about it on his first Fed press conference. Didn't really say anything about it on the second conference, but the June trim mean data came out from the Dallas Fed, and that number was 2.2%, down from 2.4%. Now, I know when I say that, no one believes it, right? No, inflation is great. It's so high. It's crazy. Which, by the way, the Fed kind of wants inflation because they want, more dollars, needed in the system. We'll get into Japanese yen carry trade, the facility, the $10 billion that we helped to prop up their currency. But inflation is actually something that the Fed wants, and for them to start hiking rates, it's like one of the last resorts, because that is short-term funding, the Fed's overnight rate, and that does a different thing than long-term rates, like the 10-year Treasury obviously shows up in our mortgage interest rates. But banks lending to each other in an overnight rate does suppress growth, which suppresses jobs. And if this inflation is not something that just got caused by this oil spike and is something more systemic, then that's what they want to see. I'm surprised to see so many people in our industry cheering for a rate hike. It's like it would crush the stock market. It would move interest rates up, at least in the short term. And it is a big reversal. It's a big deal to move that aircraft carrier in that direction. So that's why they're waiting. It's only his second meeting. And so what I thought was interesting about oil is not only do we have what's going on in the Strait of Hormuz, did you know that 50% of Russian refining capacity is offline? 50% from one of the world's big oil refiners. So it's I saw this from a gentleman talking about oil on a CNBC clip, and I am not a financial advisor. I am not responsible for your losses, only your profits. He was talking about the old economy versus the new economy, the AI trade, which I'll get into that in just a second as well. We're only 7 minutes in here. Bear with me. It's my Monday video. You got to stick with me. We're going to get supercharged for the week. Some people do hour-long podcasts. I'm like 10, 15 minutes max. So the revenge of the old economy and commodities, they are striking back. Commodities that China owns a ton, rare earth, elements that go into all the AI trade, semiconductors, EVs, electric vehicles, oil. We're seeing that. That's the old economy, right? The AI trade is the new economy, right? It's about 1% of our GDP right now, which, by the way, Mizuho, I saw a great report. They think GDP for Q3 will be 3.5% and then upwards from there in Q4. So if you believe in that final sales number and you believe that 1% hit down to 1.5 from trade is transitory or temporary, we have a growing economy. So maybe there's a reason why we haven't heard people talk about stagflation. Again, we'll see jobs report. Hard assets, local operations, HALO. I'd never heard that before. So these hard assets and local operations, refineries, oil straits, producers, commodities, mining. The Dow has been doing great. That's kind of the old, economy index, whereas the NASDAQ certainly is the new economy. So we're going to keep an eye on that stuff. It does impact inflation, and we have a supply chain issue. Is it transitory, especially as it relates to oil? Okay, so I want to get into the new economy because it will dovetail into my final comments about the Fed meeting last week. I took down a lot of nuggets, and I wasn't able to get through them all on my Thursday video. No one really watches that one compared to the Monday video anyway. Okay. Did you know between November 22 and October 24, the cost of running AI models with roughly the ChatGPT 3.5 level performance plunged from $20 to just 7 cents per million tokens? That's a 99.6% decline in less than 2 years. So AI is getting cheaper. That's good for small business. Stripe data shows the number of solo operators generating over $1 million in revenue doubled between 2023 and 2025. So AI-focused startups are running with 25% fewer employees than their peers. The labor impact may show up less as layoffs and more as companies that never needed to hire at all. It's good for small business. We see it in our industry. there are so many good new tech teams that are getting into the business. And you know me, I like to keep my finger on the pulse and meet with all of them and see how they're all doing. Over the last couple of years, there's some really, really good stuff coming out. Anthropic, right? Claude. They're not making any money. It's all hype. $10 billion in revenue in June. Between OpenAI and Anthropic, Claude and ChatGPT, OpenAI, they've gone from like $2 billion in revenue like not too long ago to like over $70 billion in revenue. Stuff is generating. This economy is moving. It's moving very fast. The new economy is moving fast. Of course, we can only go as fast as the old economy lets us. We can't go anywhere if we don't have gas in the tank. Okay, let's get in the Fed really quick. We're at 10 minutes in, and I'm just going to take a couple minutes. Forward guidance still useful in a crisis. We're not in a crisis. It's more benign now. That was a quote from Chair Warsh. Whether you believe it or not, that's what he said. So historic problem with data dependence is the data and the dependence. They want to sit back and let the market do the work, and it's doing the work on the long end. So he doesn't have to, move the Fed open market overnight rate, which is what the Fed rate is. They do different things. And so, if long-term Treasuries and the bondanistas are out and demanding a higher yield, and why wouldn't they? The economy's growing. We're going to see Friday if the job market's still steady or stable or strong or whatever name we're going to use. Or if there's more revisions and it comes in weak, then, maybe, again, no higher, no fire, which is steady or stable. And so we're going to see how that comes out. But this data dependence, why be dependent on it when the market is doing the work for the Fed like it always has? He doesn't need to hike rates. The market already hiked all the bond rates, except the lower end. The lower end, the 2-year Treasury, has come back just a little bit. And so we'll keep an eye on that as well. There's obviously a task force looking for new private and public data sources. Just talked about the trend mean as one. Revelio will have some data this week. Remember when the BLS was shut down, we had no employment data. We were looking at Revelio, Trueflation, all those kinds of things out there. There's a task force for that. So since June, now this is the thing about inflation. Since June, the June meeting for the Fed, rates went up quicker than the last 2 decades. Literally, the rate increase was in the top decile, the top 10% of all rate increases, just from June to the July meeting last week. That is a flash in the pan. And so they want to know if it's for real and if it's going to be systemic and it's going to be sticking around. Obviously, there are knock-on effects and ripple effects to the Strait of Hormuz being shut down. Will diesel continue to go up, making shipping more expensive? Will the cost of fertilizer continue to go up, making food more expensive? Those things could be systemic, even if a flash in the pan becomes a longer than a flash in the pan. So we're looking out for that. Now, we'll finish with this and give you just a couple data points on that, and then I'll talk about the Japan and U.S. deal to prop up the yen, the Japanese yen. Again, I said this last week. Chair Warsh said the economy is showing impressive resilience. There's a reason why this business is up. I started with higher first lien purchase business. There's more business in our business than last year. There was more business in Q2 than Q1 because the economy is resilient. You have to go find that business. Now, there's $90 trillion with boomers. Shout out to the boomers. And $20 trillion from the silent generation, the older generation. That's a lot of wealth. Maybe they're helping people get into houses. They're spending money. They're being a little bit inelastic compared to what's going on. Gas prices probably don't hurt them. Maybe they don't have that much debt. So they have income. The ISM manufacturing index rose to 55.6%, above the consensus of 54. That's the highest level since May of 2022. Manufacturing in the United States is up. Do you remember when we had like 18 or 19 or 20-something months in a row where that number was down? Manufacturing's up. Yes, a lot of it has to do with the AI trade, which would yield to worker productivity later, but that's a good thing, and that's part of why we're seeing higher rates. It's not just inflation. It's also because there is an underlying strength in this economy. Now, rates could actually go down if that jobs report is weak because that would show the economy is weakening. I don't know what's going to happen. All right. Japan and U.S. got together to help prop up. So basically, bottom line is we don't want Japan selling a bunch of treasuries. They're the largest foreign holder of treasuries. We don't want them selling treasuries to get dollars to prop up their yen. So there's a facility that the Fed has. It's like a repo facility that any foreign government can use to trade assets for dollars or borrow for dollars. And the U.S. put $10 billion, I think, just in this last couple days. So they're trying to make sure that there aren't a flood of treasuries into the market. Now, I will say, I don't want to say it's a sign of desperation, but it's a sign that that is something that this administration doesn't want the yields on the long bonds to go up, the third part of the mandate. That's it. I know it was a lot, 15 minutes. Thanks for hanging with me. Let's be positive. Cheers. Hey, it's KP coming to you live from Corona, California. We are pushing a 16-hour day here. It is 8:30. It is a long day, and I normally don't get a Wednesday video out, so bear with me. It is jobs week, which is super important, and the report doesn't come out until Friday. If I wait until Friday and I take all the news Tuesday through Friday, I'll have a really long video that doesn't get the best engagement. And so there is some news to get out, so I'll have a shorter video for you right now. Okay. Gary Malice is one of the 4 owners at PRMG. He's my partner who runs Cap Markets and Strategy together with Paul Rosa and Robert Holiday, our 2 founders. And Gary runs a capital markets call the first Wednesday of every month, and it's fantastic. It's super educational. And we're going to think about finding ways to get that content and get it out to the masses. It's been an internal call for 8-9 years now. But he said something today, and it was a very good thought, and I wanted to talk about it. We talk about Fed forward guidance. They're not giving you more guidance. They're not transparent. The market's choppy. That's not true. And on my last video, I said the 9-3 vote, actually my last 2 videos, the 9-3 vote is the forward guidance. And so if you think about all the times when, they're probably fighting behind the scenes, but then they put out a fake 12-0 united front, we're all on the same page vote for 63 months, it's a lie. And so, what's interesting about this 9-3 vote is it's very transparent, and that is the forward guidance. They're starting to think at this moment, at least 3 of the members, not all the members want to hold, but they're starting to lean, some of them, more towards hiking. And Gary brought up a really great point that at the next meeting in September, if that flips back to 12-0, let's say jobs reports are weak, ADP came out a little bit weaker, job openings kind of decreased a little bit. I'll get into some of those numbers in just a second. But maybe inflation starts to calm down. It's mostly driven by this oil conflict. And if we somehow get an end to it that's more permanent and lasting, we start to see an easing of that. We already know the inflation trends for just the last 3 months in CPI. And of course, you look at PCE, most of the components are actually in a pretty normal range. And so if that happens, I'm not saying it will, I'm just saying if, for example, that happens, all right, hikes are back off the table. If you look in the CME Fed funds future rates, there are less hikes being priced in this year, of course, because more time has gone by this year and we just had a meeting and they didn't hike. But if then at that next meeting or any meeting for the rest of the year, they go back to 12-0, that is the forward guidance. And I thought that was a really great point that Gary made, kind of putting our brains together to come up with one good thought. All right, so I made a point the other day, and I didn't really explain it. The Fed wants inflation, and here's why. Well, the Fed is more tolerant of inflation than you would think, even though it's part of the dual mandate, even though it's a tri-mandate. If the dollar gets weaker because of inflation, it is less expensive to have dollars, and then when they start to force more treasuries onto the market, it is easier to swallow and chase that higher treasury issuance. That's one good thing that comes out of it. So, they don't. If they hike rates, it strengthens the dollar, and that piece goes away. So they have to really think that whatever a Fed rate hike on overnight bank lending rates and 2-year treasuries, how that'll impact slowing down growth for lending and possibly moving into more job losses and maybe even a job loss-led recession, which most of them are job loss-led. Is that really the thing? I read another article today in one of my stock subscription services that said it doesn't matter what the Fed does. In about 12 months from now, inflation's probably going to moderate. And so it's kind of confusing hearing all this drum banging about hiking, especially louder, only 2 meetings in. Again, I think it's politically motivated. I digress. I don't want to go there with any of y'all. Okay, June job openings fell 7.36 million, the job opening labor turnover rate. So there's less openings. We're in a no hire, no fire economy. Healthcare was down 147,000 job openings in June. That was a job opening for June, so we don't know what July is going to be like. My guess is probably more of the same trend, at least for the headline number. Hospitality and leisure was down 86,000. Now, the hiring rate went up to 3.4%, barely off the 2011 low of 3.1%. That's something I stole right from my friends over at MBS Highway. Hat tip to them. And the quit rate went up a tenth to 2%, but it's just above 1.9%, which was the lowest since 2014. So this isn't like a booming market. It's kind of steadily being a no hire, no fire with like some wavering back and forth. So Friday's pretty important to kind of set the pace and the tone. Even if we don't necessarily believe that data, because then when the QCEW comes out, the quarterly census of employment and wages comes out and wipes out 900,000 jobs in reverse, doesn't matter. The market reacted on Friday, which, by the way, the stock market, which I'm not a financial advisor, I'm not responsible for your losses, only your profits, new all-time highs yesterday. Took a little breather today. Earnings are working. Companies, 88% of companies that have reported their Q2 earnings are crushing it to the tune of like 31% earnings growth. I mean, they're beating it. And it's adding, 2027 and of course, Q3 and Q4 this year earnings number. Now, is it circular financing on the AI trade and that thing's going to blow up like the dot-com trade? Man, I sure hope not. It's worth looking at that stuff. I'm going to give you a couple more nuggets and I'm going to end this thing. We're only at 6 minutes. Lines of credit hit 38% utilization, the highest of any revolving product. Thought that was interesting. California's equity in mortgaged home ranks number 2 in the United States. The average equity in a home is $627,000. They also have the smallest share of underwater mortgages in the U.S. I believe it was the second smallest share. And okay, so let's talk about stablecoin and how that flow of money, because it does impact the dollar, which impacts rates and everything that we do in treasuries. And then I'll talk real quick about SpaceX and their earnings and what happened to that stock, which I did not buy and I don't want to buy until I see it under 100. Some of these value investors are putting a target at like 50 before they jump in. I read an article today that says it's 3 times overvalued. It's the most expensive stock ever, and there's more room to run down. But it's a build project. We know it's a long-term play. So trying to time the bottom is hard, but I'll get into that. I might as well just say it now. There's another 911,000 shares of SpaceX that are held by employees and early investors that are becoming eligible to trade now. That's 43% more than the 638,000 that came out on the initial public offering. So there's now more out there from people who may need money. Lines of credit are up. We know about debt. We know some people are hurting. There's a survey that Gary pointed out on his Cap Markets call that 50% of people in a mortgage said in the next 2 years they need to refi or they don't think their mortgage is tenable. Of course, that's their thought, right? They could also get wages if we do have a strong labor report. And so that all stuff matters. Okay, so last thing. So if you've heard of Tether, it is a stable coin. Remember, when I talk about cryptocurrency and coins, people start to freak out, right? It's just a ledger. It's just blockchain is just a ledger, an immutable ledger. That's all it is. Okay, so at its core, it's software. And the US dollar, okay, is being pegged to a stable coin called Tether. Cantor Fitzgerald, humongous firm out of New York. If you remember them, they had some of those top floors in one of the buildings when 9/11 went down. They just have $141 billion in treasuries tied to Tether, a stable coin. Now, why is this important? By the way, that makes them the 17th largest holder of U.S. debt. Okay, I want you to think about what this is impacting us. Okay, so whether you think like crypto is a scam, currently Tether is the 17th largest holder of U.S. debt. Okay, ahead of Germany, South Korea, and the UAE, and they're about to overtake Saudi Arabia, who's been our partner forever on the petrodollar, which is important here. So we got 1 minute left, and I'll wrap this thing up and get the hell out of here. So when we went to the petrodollar, we were making the Middle East countries use dollars to buy oil and vice versa. And so that spread dollars throughout the world. And of course, when the world got off the British pound and went to the dollar, Britain, UK, and then other companies in the European Union, they started to buy treasuries, but then they would turn around and lend out and extend credit in dollars against that treasury, that dollar-backed instrument. And there was no oversight or control or taxation or whatever the U.S. government wants. And so a big reason why the U.S. dollar is the reserve currency of the world is because it's been expanded out as credit. Remember, if there's $50 million in the world, $1 million of it is actual dollars and $49 million of it is credit. So that could be why the AI trade would unwind, because it would be a credit boom, which is usually when the Fed steps in when there's a credit market dislocation. They need to provide liquidity because there are some mismatches in credit. That's really what they're looking for, especially as it relates to the Treasury. So let me just say this. So, the euro dollar and petrodollar became decentralized so much, especially the euro dollar, that now having Tether backed, with the Genius Act and the Clarity Act and all these different acts that we enacted in this administration, you must back these stablecoins with dollars and show your cards to the government. And then that way there's kind of tracking and centralization of our dollar denominations. And that's big for the United States. That's actually good for the dollar. That's good for our debt and deficit long term. So something to watch out for, the flow of money, okay, reigning in control of what's going on with the use of our dollar can help us strengthen it, which is a good thing for our debt and deficit, which is a whole nother topic we'll get into. 11 minutes, I'm out. Peace. Get back to you on Friday after the jobs report. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.